Understanding Kondratiev waves, an in-depth exploration. Kondratiev waves, sometimes referred to as long waves, are a concept in economic theory that illustrates long-term cycles in commodity prices and overall economic activity. These waves, believed to span roughly 50 years, alternate between phases of growth and decline, largely attributed to technological innovations. The theory is named after the Russian economist Nikolai D. Kondratiev, who initially observed these cyclical patterns in agricultural and industrial commodity prices. The origins of the Kondratiev wave theory. Nikolai Kondratiev was an agricultural economist who meticulously studied historical commodity price data. His examination focused on major European grain markets, where he accessed almost 150 years' worth of records. By consolidating and transforming this data, he aimed to identify long-term trends. Kondratiev's analysis revealed what he interpreted as cyclical price movements, suggesting two complete waves had occurred from 1790 to 1849 and from 1850 to 1896, with a third wave in progress during his research. Kondratiev posited that these cycles reflected broader economic realities. They were not merely phenomena of historical interest but critical insights that could benefit economic planning, particularly in the Soviet Union. This notion, however, faced severe opposition from Soviet officials who viewed it as a threat to communist ideology. As a consequence, he was imprisoned and later executed by the Soviet regime. Characteristics of Kondratiev waves. The fundamental characteristics of Kondratiev waves include: 1. Long duration. Each wave lasts approximately 50 years. This long timeframe distinguishes them from shorter economic cycles such as business cycles, which generally last a few years. 2. Phases of prosperity and decline. Each Kondratiev cycle includes periods of economic growth, driven by technological advancements, followed by periods of economic decline or stagnation. 3. Technological innovation as a driver. Kondratiev argued that major technological breakthroughs, such as the steam engine or the Internet, initiate upward waves by fostering new industries and improving productivity. 4. Investment patterns. In the prosperity phase, significant investments flow into emerging industries, while during declines, capital becomes scarce, leading to less investment in innovation. The debate among economists. Despite its intriguing notion, the existence of Kondratiev waves remains a contentious subject among economists. Critics contend that the cycles are more of a statistical illusion than a reflection of real economic dynamics. For instance, a mathematical concept known as the Slutsky-Uhl effect suggests that statistical manipulations, such as averaging, can create misleading wave-like patterns from random data. The role of predictive models. In the decades following Kondratiev's analysis, various economists and financial analysts have attempted to apply the concept of Kondratiev waves in predictive models. Notable figures such as Joseph Schumpeter, in his seminal work Economic Cycles, advocated for a series of wave-like economic patterns, arguing that these cycles were essential to understanding historical economic trends. However, the lack of agreement on various aspects of Kondratiev waves, such as the timing of cycles, causative factors, and their current positioning, keeps the debate alive. Many modern proponents are often finance-focused individuals rather than trained economists, making the concept more prevalent in investment circles than in academic economics. Interpretation of the theory today. While some investors look to Kondratiev waves to gauge the timing of market cycles for strategic advantage, the academic community remains skeptical. Observations deemed to be indicative of waves may simply reflect historical data noise rather than substantive economic trends. As data availability and analytical techniques have improved significantly since Kondratiev's time, contemporary financial analysts might find it increasingly feasible to assess economic trends empirically, underpinning their conclusions with robust quantitative data rather than relying on historical patterns. Conclusion. Kondratiev waves offer a fascinating lens to view long-term economic cycles influenced by technology and capital flow. While the underlying theory is a topic of debate, it has undeniably spurred interest in understanding economic cycles more deeply. As the global economy continues to evolve, incorporating insights from various disciplines, including economics, finance, and technology, remains essential for effective economic planning and forecasting. Whether or not one subscribes to the validity of Kondratiev waves, the dialogue surrounding them enriches our perspective on economic fluctuations and innovation's role in shaping prosperity.